Colgate shut Parliament down. What's new? But equities remain unmoved. Is it denial of reality, or is it an acceptance of non-functioning democracy? Or is it just a short-sighted view that the political theatre does not seriously intersect the corporate world? We believe that the slugfest at the top is going to pave the way for a less discretionary regime where the government finances will be direct beneficiary of a more transparent system of allocation of national resources. Going forward, if spectrum and coal block allocation are priced in a competitive manner, even at a fraction of the CAG estimate of revenue losses, the inflow can sharply reduce the fiscal deficit, which in turn can drag inflation down, thereby prompting RBI to effect follow-on rate cuts. Together, that can sharply reverse a seemingly unstoppable slide in macroeconomic health and kickstart the investment cycle. Already, notwithstanding the chorus of protests from telcos, the impending auction of 2G spectrum promises bounty for the beleaguered government. Mr. Chidambaram then can perhaps afford to be generous in the Vodafone matter. PM's think tank has projected a revised growth target of 6.7% after RBI scaled down their forecast from 7% to 6.5%. Equity research houses have been more aggressive in lowering their projections to 5.5%. Take your pick. But the market refused to react. Could it be that the negatives have already been priced in? China tells a different story. Here is the fastest growing economy that clocked a 7.7% growth rate last quarter. Shanghai Composite Index, by the way, is consistently recording new lows for 2012. Overseas news offered little cheer. Despite Fed minutes suggesting another round of quantitative easing, should weakness persist, the latest economic data on employment and consumer confidence were far from encouraging. Dow fell end of last week. The inevitable slow progress in political consensus in Europe and consequent fall in equities once again signaled that the market had run ahead of itself. In the toss-up between inexpensive valuation and low growth, Europe should stay in a trading zone for a while. Isn't Pakistan described as the most dangerous place in the world? Certainly doesn't correlate with the performance of the markets. Over the last 12 months, Pakistani rupee has depreciated 7.5% against dollar, while Indian rupee has fallen 20%. On the equities side, amazingly, Karachi 100 index has advanced 34% against Nifty's modest gain of 7%. Just for the record, Shanghai Composite fell 20% in the same period. So much for fundamentals. Oil is looking threatening again. At $115, Brent has shot up by 12% over the last 1 month. With Mideast tension escalating and technicals suggesting further rise, Brent could test its previous high of $126. Not a happy situation for India. After a quiet period of almost 18 months, gold seems to be waking up from its slumber. Having scaled a peak of $1,920 in September last year, gold prices have formed a solid bottom around $1,550. Last week, it broke out of the recent trading band between $1,550 and $1,630, ending at $1,670. Charts seem to suggest major trendline resistance at these levels, but if broken, gold could be glittering again. John Paulson will just pull it off once again. The technical structure of the market has been improving over the last 3 months, and aggregate data suggests that sentiment is slowly but steadily shifting in favor of bulls. That equities have remained steady in the face of continuous negative news flow signifies strength. FII investment of over $11 billion and valuations at the lower end of the historical band confirm this hypothesis. However, the turnaround in sentiment is both nascent and tentative. There is every possibility that the market may continue to be in a trading zone for a while yet. For the immediate, we see Nifty having a bearish bias for the next week. Quantitative pair fund, as expected, has maintained steady performance. Unlike a more active market when we managed to book much wider gains, in recent months, individual profits have been modest. However, we still continue to outperform Nifty handsomely with an annualized return holding steady of over 16%. For the coming week, we are closely watching the entire universe of banking and technology stocks for entries. We have slowly been reducing our cash holdings in comparative value fund in sync with changing market internals in favor of an upturn. While Bharti Airtel has so far dented the portfolio return by 3%, we believe the stock is at or near its bottom. While the sector suffers from a lack of visibility, the recent gain in market share is welcome. We believe the stock is poised to recover ground. Last week we entered Siemens, which we think has bottomed. We will add to our holding when we see attractive entry levels. Next week, if the market stays flat to weak, we may choose to stay out. Thank you for watching.